Hello, and welcome to the sixth episode of the Plain English Finance Podcast, the podcast dedicated to helping you make smart financial decisions. I'm your host, Trey Bino, a certified financial planner, chartered investment manager. I am a financial planner with TCU Wealth Management and Aviso Wealth. For more information or to send your questions in, check out the show notes at treybino.ca/podcast. And if you want to learn more about me, start with episodes 1 and 2. Let's get into the episode. I'm joined here with my wife, Sierra.
Hello.
So this episode, I wanted to talk with you about why people should track their net worth, why that's a really important number. What do you think?
Honestly, when you told me this was the episode we were doing, I kind of was like, okay, but then just didn't give it a second thought. And I don't really know. Like, I know why you would want to know that, just because we've done different lending things, like mortgages. They ask you for a net worth statement. And yeah, that's my experience with it. So it's like, that's all I really know, I guess.
That's fair. Do you know what net worth is, like how you try to calculate your net worth?
Yes. So you have your assets minus your liabilities. So that's your net worth.
So what are some assets you would include?
So I guess like savings account, like cash, I guess, investments. I want to say equity of a house. Is that right? Is that how you say it? Like there's a mortgage on a house sometimes, and I know that a house is different from a vehicle, let's say. For a net worth statement. To be honest, when we did our net worth statement, here's the truth, everyone. I just get Trey to do it because he is a certified financial planner and I am not. So why would I do that?
Everybody should track their net worth.
I know.
So explain to me a liability.
So a liability is something that costs you money.
It's typically, when it comes to a net worth statement, it's just money that you owe. So an asset is anything that you have, and a liability is anything that you owe.
So an asset is what you own.
Yes.
Basically.
Yeah.
And a liability is what you owe.
Yeah. So when you're talking about equity in a house, that shows up on a net worth statement. So let's say you had a house and it was worth $500,000 and you had a mortgage against the house that was $300,000. That $200,000 gap is equity. That's the equity in the house. And everybody should do this across the board for all of their assets and liabilities, everything really. And how often they should do it depends. Like I do it with clients every single year and I track it for every one of my clients so we can see progress over time. But depending on the challenges you're currently facing with your finances, it might be better for some people to do it more often than others. But once a year is probably a good minimum that you'd want to do it for. So you mentioned a good reason why somebody might have to create a net worth statement. So one of them is if they were applying for a mortgage or applying for a loan or something like that, the bank is going to require a list of your assets and liabilities, and then they will turn that into a net worth statement. Do you know why the bank would collect net worth statements?
Well, I'm thinking, again, from a credit point of view, it would kind of fall under that credit piece. So sorry, maybe not. I'm going on a little bit of a tangent here.
Yeah, okay.
So there's, one of them is collateral.
Collateral is what you're on the right track.
It's basically to say, okay, the bank is saying, or the credit union or whoever is saying, I'm going to give you this money. What is the likelihood that you're going to pay me back? And if I need to take some of this money from you.
I'll take the stuff that we're lending.
Yes, that's what I mean. Like,
That's collateral.
What can I get out of it? So that's why I'm thinking like, okay, you're going to look and see like you have a house, and if everything kind of falls apart in that person's life and they can make you sell the house, or like they're going to take the house and sell it and try to pay off some of that mortgage or loan or whatever. Anyways, all that being said, I did also notice you said you make your clients do it to track progress, which is kind of interesting, but I would say that's another reason why.
So the banks typically will get people to do their net worth statements. A whole bunch of reasons, like you just said. But it also, for somebody that knows what they're looking for, it tells you a lot about a person. If I see somebody's net worth statement with no information on them, I would be able to tell a great deal about whether these people have kids. I could give you an idea of their income. I could give you an idea of their priorities in life, likely how they were raised. Very likely I could be able to tell you where they're headed, where they'll be in 10 years' time, because you can see patterns. You can see somebody's trajectory, like their financial trajectory, through a net worth statement. So I one of the biggest reasons I do it is for my own sake. I want to make sure that I don't miss anything when I'm working with clients. Keep in mind, I work with a wide range of clients, and quite a few. So it's important for me to know that I'm not missing something. And the first place you would be able to see in a lot of areas that people miss, it's going to show up on their net worth statement. That's one reason why I always do it for every single client, track it. The other reason is progress, right? So it helps the client see where they came from, where they're going, during bad market swings, ups and downs. Maybe something goes wrong in their finances, in their financial life. Maybe they lose their job, whatever it is. You can see it often helps people calm down a little bit, because you can kind of see
It's like
see where you're at.
visualizing.
Yeah, exactly. It's really difficult to say, oh, I know roughly where I came from, and I know I've made progress, but to actually see it quantified is different. It kind of hopefully gives you a little bit of peace of mind depending on the direction that you're going.
Well, that is the same as, it reminds me of the saying that we've already mentioned, which is closing your eyes doesn't make the demons go away. So, yeah, it's either a good thing because your numbers are good, or it's a good thing because now you know the bad position you're in and you can change it and not just pretend like everything's fine.
Yeah. Yeah. 100%.
So it's a good thing or a good thing. So
yeah, it's a good thing. It's something that, everybody should track. Also, it's kind of a truth teller. Like, it keeps you honest. So a lot of people will they'll think to themselves, oh, I'm good with finances. And they'll do that based on their income or based on stuff that they have. A net worth statement gets rid of the masks. Like, it doesn't matter how much you make. If you have a negative net worth and you make $200,000 a year, you have fundamentally bigger issues with the way that you manage money, and you need to be looking for help. If you're out there and you're listening to this and you're on the fence about whether you really need to get help or not, do a net worth statement. And if it's negative, you should probably, you need help in some capacity.
yeah, because at that point, that's a behavioral thing.
Yeah.
Right? It's either lifestyle inflation, which we've talked about before, or you and I, not on the podcast, but maybe we will. Or something along those lines where they don't have a budget at all. And because their income is high, they think they can spend like there's no tomorrow. And that's just not how life actually works.
No, exactly. So yeah, definitely something that I would recommend people do for those two reasons. There's another reason though, is it helps you make better decisions for the future and for now. So a really good rule of thumb when you're buying, so I haven't even talked about depreciating assets. So okay. Depreciating assets.
That's like a vehicle, right?
That's like a vehicle. So something that goes down in
yeah.
value. So I don't include those on my net worth statement, but there's hit and misses to when I would include those. So obviously if it goes up in value, it's investment. It goes on my net worth statements. If it's like farming equipment where the equipment is used to make an income, then it goes on my net worth statements. It's something that is just you purchased because you have a new vehicle and you wanted a new vehicle. That doesn't go on my net worth statements because the gap is so big and people tend to drastically overestimate what their depreciating assets are worth.
So where would you put it? Would you put it as a liability, or where would you
put it? If there's debt against it, I put it as a liability, but if
you don't add
I just don't add it as an asset.
Okay,
but I could definitely see, like, you probably should add it as an asset.
Yeah.
But I don't. And that's purely because that's more of a principle thing than anything else. Like, it goes down in value. It's a cost It doesn't put money in your pocket. It's not like it's a taxi, right? If you had a taxi company and lots of vehicles, then it would be assets, right?
What
But
about like a work truck?
yeah, if you use it to make money, I'm all for it. Or I put it down as assets. If somebody like, they have a like collectors vehicles and things like that,
Oh,
then
yes.
I'll
Yeah.
do it. Artwork, even things like that, like a large amount of jewelry, things that tend to maintain their value or go up in value, I'll put it down. But typically things that don't, I don't put it in there.
What else is a depreciating asset?
Boats,
Oh, yeah.
campers.
It's basically anything vehicle related. Well,
Yeah, because they
camper,
go
I
down.
guess.
Well, they go down in value. It's a consumer item, so it's great to you can purchase them, go for it. It just isn't an investment, isn't an asset.
Right.
But I can see both sides of that. If you are doing a completely honest, as long as you're truly valuing these things, maybe you could put them on there. Like you're using like I think it's like YMR or whatever. You can go and value vehicles and put how many miles is, and it's always lower than you think, but
Yeah.
you could do that.
The used car market right now is
Oh,
ridiculous.
don't even get me started on the used
It's
car
not
market.
real right now. So.
It's crazy. And then the other thing I've already touched on a little bit is just peace of mind.
Yeah.
So just like a lot of things, when you have a plan, when you're tracking where you are, you know where you are, you know where you've come from, you know where you're going, it just can create peace of mind. Something that I wouldn't say sleep better, but you feel more in control.
Yeah, that's what I was thinking again. Like, I know we're probably going to say some of the same words a lot, and I don't love this word because I am not a corporate jargon person at all. I hate when people talk like that, but to empower you. And empowering is a very like corporate-y word, I
But
know,
it's true.
but it is true. It's the right
phrase.
it's the
Yeah.
correct word, right? Like you do feel in control and feel empowered to make better decisions. Sometimes I think people think of a financial planner as somebody who manages investments. And like even for me when you first were like starting into wealth, I thought that was going to be 90% of your job, investing. And now it's like all of this other stuff is actually all around planning. Knowing your net worth statement is all part of financial planning. I mean, maybe that's obvious. People might be like, yeah, hello. But
No, I think a lot of people don't. A lot of people don't. Even when I brought my associate on, and she was on the credit union side, like did lending and stuff.
Right.
She didn't realize the extent of what we did because it's just a very different world.
Yeah.
It's changed. Wealth management has changed over time. It used to be stockbrokers that were just like these sleazy salesmen on Wall Street.
Yeah.
And it's shifted over time. It's gotten better and better and better. And now it is good planners, and this is why it's important to have a good one. It's very different. It is about direction. It's about controlling what we can control and minimizing costs on the investment piece. There's so much research there. We'll have an entire, probably multiple podcasts on the investing piece.
Yeah.
But the investing piece is not the same as it once. We have enough data that we know that isn't where you add true value. Where you add consistent value is everything else. It's all the planning. It's the estate planning, the tax planning, the investment planning, the asset allocation, the asset locations, the risk management. There's so much more to it.
Yeah.
That's very time consuming, but
Yeah.
all of that starts with a net worth statement.
Yeah.
So it gives you a benchmark, a personal benchmark to use, and it shouldn't really be used as something to like compare with your peers. But doing so does give you an idea, right? It gives you an idea of where you're at, if you're making reasonable decisions, if you are overspending, if you haven't focused on wealth accumulation enough. The fact is, as time goes on, you want to be accumulating. If you're not accumulating in some capacity, then you're probably overspending. And I would say even further, not only are you not accumulating, you're decumulating, and your net worth is going down and down and down, then that's a big problem that has to be fixed later. There are parts of your life that is kind of unavoidable. Schooling is one of them. Vast majority of people start out their life with a negative net worth, which is why it's very important to try to fix that as soon as possible and don't let lifestyle inflation run away from you, because fixing a problem after the fact, after that problem's already happened, significantly harder than fixing it beforehand.
Just quick question. When you were talking about wealth accumulation, so would that be just simply like, oh, yeah, my assets are higher than my liabilities? Or is that kind of, would you say someone who's just saving they still need to look at accumulating wealth, if that makes sense? Like, let's say you have a lot of cash on hand or something.
That's still like a net worth statement will tell somebody like me that type of all that type of information, but for yourself, that won't instantly tell you.
You're like, oh,
what you
look
should
at all
be
this
doing.
cash I have.
Yeah, it wouldn't do that for you, but the net worth number would be going up, right? So you would at least know. You might not know how to optimize it. You might not know that you're doing something wrong. You might not know that
there's this other account that you could be using that would benefit.
Yeah, you wouldn't know those things, but you would know, hey, I'm not overspending. I'm not getting into more and more debt. My lifestyle is reasonable compared to my income. A net worth statement would tell you all of those things, even if you weren't being very efficient with what you're doing with your excess funds. It just tells you that you're doing okay.
Yeah, it seems like it tells you a little bit about your behavior in finance. Where, okay, I clearly, if my net worth is positive, or if I have more assets than liabilities, I have good behavior. And the opposite would be true as well. If you have a lot of debt, well, depending, I guess, like you said, if it's schooling and things like that, maybe not so much. But it would give you an idea, like, because a lot of people say that they are good with finances. And like you said, then you have the truth-telling net worth statement. And people think, oh, I don't overspend. I don't do this. I don't do that. And maybe it's not true.
No, it's true. 100%. When I was looking at some information for this, I came across a net worth target number on how roughly to calculate it. So the target net worth, kind of how you know if you're in the right range, would be your age. So let's say you're 40 years old minus 25. So that would be 15. And then you'd times that by 20% of your gross annual income. So let's say you were earning $200,000 times 0.2. It means at that age, your target net worth would roughly be around $600,000. And that kind of gives you a very rough starting point to know how you're doing compared to your income.
Right.
So yeah, I'll put that calculation in the show notes for anybody that wants to plug their numbers in and see.
Yeah, I should plug my numbers in and see.
Well, I've already done it for you. So,
okay.
Do it as a couple or whatever unit you're in, but that's the basics. And it doesn't have to be very complicated. It can very literally just be a basic Excel spreadsheet, as long as you put, like, honestly, like in the A, B, C, D, E, like in B column, just put like 2025, 2026, 2027, just along the way, and then put a list of the assets and track how they're changing over time. Is more than enough. That's all you really need to do. Or if you work with me, just ask me to see yours, I guess. Yeah. But yeah, definitely something that people should be doing. So yeah, that's it for this episode. I think we'll wrap it up there, unless you have anything else to add.
Nope. Everybody, after this episode, get your pens and papers out, or your Excel documents. I guess, I don't know why, like, does anybody use pen and paper for these things? Probably not, but...
Well, then you'd have to keep it over time. Maybe for somebody that will, I don't know. Just, it doesn't matter how you track it.
Go get your calculator, don't use your phone, don't use your computer.
Yeah, no. Track it somehow, figure out how to track it. Lots of worksheets online. Yeah, start today. I'd like to do it once a year, just at the bare minimum, and sit down and see what it tells you. Perfect.
All right.
I'll see you in the next episode.
Bye.
Thanks for listening to this episode of the Plain English Finance Podcast. Trey Bino, Certified Financial Planner, Chartered Investment Manager, is a financial planner with TC Wealth Management and Aviso Wealth. You should always consult with your financial, legal, and tax advisors before making changes. This podcast is provided as a general source of information and should not be considered personal investment advice or solicitation to buy or sell any securities. The views expressed are those of the individual and are not necessarily those of Aviso Financial Inc. Mutual funds and other securities are offered through Aviso Wealth, a division of Aviso Financial Inc.